Hello, and welcome to Investment Insight, your clear take on the markets. Let's get started. We are launching a deep dive today into some really big structural shifts happening globally, stuff that defines industrial power now. Our source material points to this underlying theme. It's an escalating war for, well, technological control.
Exactly. And it's playing out across essential materials and high-stakes manufacturing, that concept of supply chain sovereignty. It's really changed. We're way past just talking about tariffs.
Yeah, this feels different.
Oh, it is.
Yeah.
This is like a strategic, active war over materials and manufacturing. Nations are basically weaponizing their unique industrial strengths. And for you, the investor, this means you got to reassess immediately. Your basic assumptions about global stability, component costs, they're shifting under our feet.
Okay, so our mission today is to cut through that complexity. We're unpacking two huge stories here. First up, China's big move on rare earth exports. It's really dramatic, very strategic. It's not just about, controlling the raw dirt anymore.
It's about the IP, the recipe.
Exactly, the recipe itself. And then second.
Second, we'll dig into aerospace. There's been a definitive structural changing of the guard, that old Boeing versus Airbus rivalry.
Yeah.
It's basically over, at least in the way we knew it. The whole market landscape has changed permanently, which, signals a pretty clear path if you're investing in the skies.
Okay, let's tackle rare earths first. This shift, it feels critical. For decades, the game was simple, right? China controlled how much raw mineral left the country.
Simple volume control, yeah.
But our sources confirm this massive evolution. China is now controlling the technology, the know-how needed to turn that raw stuff into something high performance, something usable.
This is the pivot point. This is where the game changed. Remember that analogy we talked
With
about?
our one? Yeah.
Right, China used to just control the flour you needed. Okay. Now, maybe you buy that flour from a mine in, say, Montana. Doesn't matter. China now controls the patented recipe, the special leaven you need, the actual technique to bake that high-performance loaf, that critical component.
Yeah.
Without that specific tech, the raw ore, it's practically useless for the really high-tech stuff.
That makes the threat crystal clear. So specifically, what tech, what processes are actually restricted now?
Well, the source material is pretty explicit on this. They've put controls on sophisticated stuff, high-efficiency refining, producing specific alloys, and the big one, high-performance, rare earth, permanent magnet manufacturing technology.
Okay, refining and alloys, those sound like bottlenecks.
They're key choke points. They're how you turn common kind of low-value dirt into the specialized high-purity material you need for manufacturing.
And why is everyone suddenly talking about permanent magnets? These sound kind of niche.
Oh, they're anything but niche. These magnets, you don't see them, but they are the silent heart of, well, the whole green energy transition and modern defense.
Like what?
We're talking components for virtually all electric car motors, the powertrain in those giant offshore wind turbines, guidance systems in advanced missiles, modern fighter jets.
Oh.
And here's the kicker. China currently controls over 90% of the global market for the highest performance, kind of these finished magnets.
90%.
90%.
Now, Beijing frames this as just preventing military diversion, but the market sees it differently, right? Like a direct countermove?
Oh, absolutely. It's seen as a strategic counter. This is that tit-for-tat escalation we've been seeing.
Yeah.
The U.S. restricted access to crucial semiconductor tech, the brains, to China.
Right.
Now, China hits back by restricting the essential rare earth processing tech, kind of like the heart from leaving China. It basically confirms the technology hegemony war has spilled over. It's not just software and chips anymore. It's down to foundational materials now.
Okay, so if controlling the recipe makes every EV motor, every F-35 component politically volatile, how does that translate into investment strategy? What do you do?
Well, this strategic weaponization, it forces decoupling, getting away from reliance on Chinese supply chains. It's basically mandatory now for the West. Yeah, it's not really a choice anymore. It's become a national security imperative.
That sounds like a massive opportunity in mining. But wait, isn't starting a new mine in, say, Australia or North America super risky and incredibly slow?
Yeah.
How fast can that actually work?
It is slow, no doubt. But the money flowing in will speed things up. So opportunity one, like you said, a flood of investment into non-Chinese mining and, crucially, refining projects. Allies like Australia, Canada, the U.S. But you should also look very closely at urban mining companies.
Urban mining, what's that?
Yeah, urban mining is basically extracting rare earths and other valuable stuff from old electronics. recycling.
Ah, like old phones, laptops.
Exactly. Old phones, laptops, EV batteries. It offers a more sustainable way, and it's politically safer, creates a kind of circular supply chain.
Interesting. But the really disruptive long-term play, that has to be finding alternatives, right? Neutralizing the threat completely.
Absolutely. That's opportunity number two. This whole situation just accelerates research into non-rare earth technologies. That's the ultimate game changer. For instance, investors should be watching companies developing alternatives to those neodymium permanent magnets. Things like switching to non-rare earth motors, ferrite motors for EVs, maybe.
Okay, ferrite motors. Explain the difference quickly.
Sure. Neodymium magnets. Super powerful, but they rely on those rare earth elements China controls. Ferrite motors use common stuff like iron oxide, ceramic materials.
Okay.
That might be a bit bigger, a bit heavier, but they totally remove that geopolitical risk. So when China squeezes the supply of one type of magnet,
Demand for the reliable alternative spikes.
exactly, demand for the stable non-rare earth option goes way up.
What about just investing directly in the Chinese producers? I mean, they'll benefit from higher prices, right?
That's a high-risk gamble. Yes, short-term Chinese rare earth producers benefit, but any investment there carries a huge inherent political risk, meaning not just a fine, it's the risk of sanctions, getting cut off from dollar transactions, maybe barred from selling to major U.S. and European customers. You have to factor in that massive risk premium if you're looking at those short-term gains.
So basically, a cost increase baked into every major Western car and defense platform for a while.
For the near future, yes, that seems likely.
Okay, let's shift gears. Moving from materials deep in the earth to components high in the sky, the aerospace industry. The competitive landscape there has changed dramatically. Our sources show Airbus is just in its strongest position ever, while Boeing, the king for decades, is really struggling
The
structurally.
numbers are stark. They
Yeah.
really are brutal and unambiguous. You look at the latest delivery data, Q3 2025. Airbus delivered, what, 220 aircraft?
220. Oh,
Boeing, just 70
wow.
in the same period.
Wow, that's a huge gap, 3 to 1.
Yeah, 3.1 ratio. And it's not a blip. It reflects this deep, sustained structural dominance now by the European manufacturer.
And Airbus had a big milestone too, didn't they? Something symbolic of this shift.
They did indeed. The Airbus A320 family.
Mm-hmm.
It officially overtook the iconic Boeing 737. It's now the most sold jetliner in history.
That's huge.
It is. That shift in volume leadership, which was Boeing's turf for like 50 years, it signals the end of the rivalry as a real head-to-head fight.
What's so interesting, though, is Boeing's core problem isn't really demand, is it? They've got massive order books.
No, demand is there.
The issue is capacity and quality control, right? They just can't get the planes built and delivered fast enough.
That's the number one constraint, and it's frankly a self-inflicted wound. The biggest choke point is that FAA production cap.
Still, from the January 2024 accident.
Still, that cap limits the 737 MAX output to under 38 per month. That single restriction put in place by the regulator because of quality control failures. That's what's holding back their commercial recovery. It's kind of astonishing, really. One accident nearly 2 years ago is still dictating their output today.
But we did hear Boeing making some noise about maybe increasing that rate.
They are trying, yeah. They recently mentioned pushing towards 42 per month, trying to show confidence in their internal checks.
But the FAA hasn't budged.
Not officially lifted the cap, no. So it just shows this slow, painful path back, and it's totally dependent on regulators giving the okay. Airbus doesn't have that hanging over them.
Meanwhile, Airbus is just sprinting ahead.
At full speed, they're aggressively expanding globally. Assembly lines in Alabama, Tianjin in China.
And they're aiming for, what was it, 75 A320s a month?
75 A320 family jets per month by 2027. That's a massive number. It basically guarantees phenomenal sustained growth for them.
So from an investment angle, this consolidation, it means aerospace manufacturing is now basically an oligopoly with one dominant player.
Effectively, yes. An oligopoly dominated by one overwhelmingly powerful player.
Okay, so strategy A, the new king, Airbus. Ticker AIR, you're saying they're the safe core asset now in aerospace. Why so guaranteed?
2 words. Pricing power. Airlines know Airbus is pretty much the only game in town if they need new single-aisle jets delivered anytime soon, like in the next 5 years.
Right.
So Airbus has this guaranteed growth runway as they ramp up to that 75 a month target. And that translates directly into really profitable, high-margin sales. But strategy B, which can often give you better leverage, that's the Airbus supply chain ecosystem.
Ah, the suppliers.
Exactly. Look closely at those key European component suppliers. Companies like Safran, MTU Aero Engines, Thales, they benefit directly from Airbus's huge production ramp-up. When Airbus wins this big, their critical suppliers win right alongside them.
Okay, makes sense. But what about Boeing? I mean, people love the buy low idea. When is an old giant trading at a discount an opportunity, and when is it just a value trap?
Right now, Boeing is definitely a high-risk contrarian investment. It really remains a falling knife until you see two clear signals that things have stabilized fundamentally.
Okay, signal number one.
First, the official FAA removal of that production cap. That's the biggest signal to the market that quality control is genuinely fixed.
And number two.
Second, you need to see a stable, confirmed production rate get back above 50 per month and stay there, meaningfully recovering. Until then, the risk is it's severe.
But hang on, the company isn't going bankrupt, right? They have that huge defense division. Isn't that healthy? Why doesn't that stabilize the stock price more?
That is the lifeline. But it's absolutely crucial to separate the two parts of the business. Boeing's defense and space division. It's healthy. It keeps generating steady profit, which is exactly why investors must analyze Boeing using a sum of the parts valuation, SOTP.
Okay, SOTP valuation. Explain that simply for our listeners. What does that mean?
Sure. SOTP just means you break the company down into its main businesses, in this case, defense and commercial. You value each one separately, based on its own earnings power. Then you add them up. It gives you a truer picture of the stock's underlying worth. That steady defense side provides a really important floor for the stock price. It buys the commercial side the time it desperately needs to fix its quality problems without, risking the whole company collapsing.
Got it. Okay, so we've covered two massive shifts today. The tech war moving into core materials, which forces this global drive for tech independence.
Right, a mandatory shift.
And then the definitive changing of the guard in aerospace, signaling this long-term advantage for Airbus and its suppliers. Both stories demand you really reassess where the opportunities are, moving away from maybe assumptions based on the last decade or two.
And it really brings up a fundamental question, doesn't it? One that governments, corporations, everyone is wrestling with right now. As global powers increasingly use essential tech, essential resources, as political weapons, how much should the U.S. and its allies really be willing to pay? Pay in terms of investment, subsidies, accepting higher costs for components to achieve genuine, reliable technological independence. Is sovereignty worth any price? That calculation, that's what's driving huge capital flows right now.
Something to definitely think about. Don't forget to subscribe and hit that like button.